Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. It's going to be related to commodities, wealth building, and or financial topics. I'm going to interject my financial opinions all along as we go. And we're going to dive in here right now and see what people are talking about. So if you want to follow me, it's at finding_finance. And if you want to join the website where we talk about individual companies or you need further help on market conditions or learning these markets, you can go on there and use the word discount in the coupon code. So RevCap says, Fed's daily. If financial conditions eased more, the Fed would need to take note. The Fed is literally trading equities and bonds in a 5 to 10% band and buying time, hoping inflation goes away. There is no game plan beyond that. And I think that's the case. They're trying to just hold rates in a level and hoping that inflation goes away. That's all they can really do. What they're going to do, at least the way that I perceive it, is that they're holding rates at a high enough level to choke the demand from the real estate market, which is a credit creation area. So they're going to slow that down, but at the same time, they're causing problems with interest payments on the debt. And that's the situation they're in. They can hold the interest rates up and try to choke off the lending in the system, which will slow down inflation, definitely. And I think they've been successful at doing that. But at the same time, we are racking up lots of debt from the interest payments on the debt that's rolling over. So I think they're going to try to hold this thing up. They're probably going to try to get a recession or a slowdown in the market. They're going to lower rates at probably some point because they're going to be in a difficult situation where if they keep rates high and things are slowing down, what's their next game plan after that? If they lower rates, the inflation will come back from bank lending. If they don't lower rates, you have an economy that's slowing down and your interest payments continue to go up as bonds mature and they get rolled into new bonds being released at higher interest rates. So they're in a weird predicament there. Peter Brandt says, it will be interesting to see if this market can expand beyond this PETH of pi. That's Ethereum. And you can see that we've broken down to the downside here, and we're in potentially a wedge that could be a continuation pattern to the downside is what I think he's implying as it's entered the pattern from the top side down. Now, I don't know if I necessarily take that same take, but we'll see which way it breaks. I don't really have I don't have a horse in this race here, but it's fun to watch. Peter Lynch, one of the best investors, he says the real key to making money in stocks is to not get scared out of them. And I think that is going to be the case with all this volatility that's coming in the markets. I mean, that's a key point to make. If you're going to make money from stocks, you can't get scared out of them. And then you got to have strategies. I think when you're investing, do you buy when things are down? And that's when you buy them. And you can buy things in tranches. You don't have to buy everything in one shot and try to time the market. And if something's cheap, doesn't mean that it has to go higher. It can still get cheaper. So cost averaging in, I call it sprinkling into positions, is how I create my positions. And sometimes your timing can be off. And anything in the short term can move the markets. It can be anything. You can have a really good chart setup pattern, and news comes out, and then boom, it gets hit. Or something else comes, weather related, whatever it is, and things move lower. The country of I don't even know how to say that. Malawi, Malawi, devalued its currency by 44% today. 44% of the value is gone just like that. The value of fiat currencies is like playing a game of musical chairs. And that's why I don't keep a ton of wealth in these currencies. They're not a store of value. And you can tell 44% of value gone in one day. That's getting smoked. Absolutely. Another one from Peter. He says a decline in gold is the absolute best thing that could happen from a classical charting perspective. A decline toward 1700 would then establish a properly balanced right shoulder of a continuation inverted head and shoulders that can propel prices to $3,600. This is GLD and the gold futures pricing. What do you guys think? In the comments, let me know what you think gold's going to do. Do you think it's going to do a shoulder, head, shoulder like he has put here? Or do you think we're going to break to the upside? What's your opinion there? Not that the opinion necessarily is going to move the market or anything, but I'm just curious to see what other people thought on what they think gold's going to do here in the short term. BMO on the copper market, production deficits from 2026 onwards. Keep these dates in your mind as copper could get into a little bit of weakness in the short term. It's not a huge surplus. It says we model 175,000 ton copper surplus in 2024, small relative to the market size. And sometimes when they're really small imbalances like this, you're basically in a balanced market. But then you can look out forward and you can see very large deficits that come in 2027 for sure. There it is there. During the pandemic, excess money, the spread between money growth and GDP growth, soared to 30%. But since last year, the Fed has been mopping up this excess in a meaningful way. I'm going to click on this guy here, make sure we can see this whole thing. And what we're looking at is this shaded area that goes up and down. And that is generally the business cycle or a cycle that deals with excess liquidity. And that's the year-over-year change in M2. This is the M2, they call it bank deposit trend line. So here's your deposits going around that trend line. You can see we were dipping below 2018, 2019, came up massively in 2020, and then we're dipping back below the trend line. So what's he doing? He's soaking up that excess liquidity in the market, and this could cause a slowdown. It's possible. And that slowdown obviously could be felt in stock prices and assets going lower, depending on how they work this and how they handle the M2 money supply here. Justin, another one from Jurin. I think his name's Jurin. Higher structural inflation flips the correlation between stocks and bonds from negative to positive, as happened in 2022 and during the mid-1960s. If 3-4% is the new 2%, this positive correlation may well continue, with implications for the 60-40 portfolio paradigm. So this is the stocks bonds correlation. This is your positive correlation between stocks and bonds from 1967 all the way to 1999 or so, or 2000. This was the 60s here when it went negative. This is a negative correlation between stocks and bonds. What that means is that stocks and bonds went in opposite directions. These, if they're positively correlated, they mean they go in the same direction. So the stocks could go down and bonds would go down and vice versa. We have just inflected positive here on the right-hand side where there could be a positive correlation between stocks and bonds. And that has happened or occurred at some of these big bull markets of commodities. So it's more information, more data supporting a commodity bull market and how these assets are correlated to each other. You can see here in the 60s, we had that correlation. That was a big bull market. In the 70s in commodities. We also got that big bull market over here too in the early 2000s, but that was a negative correlation between stocks and bonds, and it started over here. You can see we went sideways. Sideways here, and I think we were going sideways and starting that again. US 5-10-year inflation expectations rise to 3.2%, highest since 2011. So these are the University Michigan survey, expected change in prices during the next 5 to 10 years. You can see that we were actually very high compared to history, 3.2%. It was 3.1% in January of 2022, and it's staying at a higher level than history. History being, 2017, 2018, very low inflation expectations. It peaked here in June of 08, 3.4%, and then declined after that. So we'll see where this peaks out, which is kind of interesting. Grady says, the commodities bull started 3.5 years ago and will bring great pain, originally caused by decades of debt issuance and currency debasement. Big inflation often starts with commodities. Make use of it and prosper, or ignore it and suffer are the options, really. Do choose the former. Make use of it and prosper. The dividend snowball happens fast. First, your dividends cover your phone bill. Then your dividends cover your weekly grocery bill. Then your dividends cover your monthly mortgage bill. Then your dividends cover all of your yearly living expenses. And I'm playing the dividend snowball, and I'm doing it there. Where I'm at is I'm at probably this level here. My dividends are covering at least my monthly mortgage bill that are outside of my retirement accounts. In my retirement accounts, they're doing very well. And that's where a lot of my dividends are at, so I don't have to pay taxes on them. So that's kind of where I keep some of my dividends there. Legendary oil mogul Harold Hamm eyes the next stage in the U.S. shale oil boom, Generation 3 rock market insider. A turn toward new practices would come as site depletion becomes a growing worry for the sector, while rising costs mean drillers need higher crude prices to profit. And that is, we are seeing that impact. We're seeing the rig counts drop, even though oil prices have been over, $80, roughly speaking. So that is a little bit interesting there. Here is this is UseLink, Casper. Yeah, it seems like the commodity prices are just recharging within the monthly bull flag. Next wave of inflation will show itself upon the break of the upside. So this is the CRB Index. There's your 1, 2, 3 hump consolidation, the break higher, and we are consolidating sideways at this moment. Hopefully we can get a break to the upside here and resume into wave 3 of this. Nice chart there. Logan says, I'm going to repeat this. No consumer in America is saying, let's wait until the baby boomers die to buy a home. The consensus shows, once again, we aren't Japan. If you believe a man or a woman is actually thinking about what demographics will be like in 2080, then probably you're a little weird or crazy, maybe. And this guy, he's continuing to be a bear in the housing market. And he keeps driving home the annual birth rates and stuff like that. But that, in my opinion, is after the millennials come through home buying years. Commodities, hard assets have again broken out big time versus U.S. stock market financial assets. Since the commodities bear market low back in March of 2020, you can see this big break. Here's 2020 bottom. Broken out, consolidation, we're breaking to the upside against the S&P 500. So that's looking good for commodities. Mike Simonson says, one way to this about whether unaffordability is likely to result in a home price correction is a factor of population. People per available listed home. Austin has 10 times more listings per capita than San Francisco. Austin has 2.25 million people and 8,700 homes for sale. 258 people per listing. In San Francisco, it's about 8 million people, 29,000 homes, 2,900 homes. That's 2,672 people per listing. San Francisco may never be affordable to the median income, may be affordable only to the top 10%. Austin is in much more of a risk of home price decline because of unaffordability. And that is something to look at, and how you could measure how strong your housing market is listings per capita, is what Mike is saying. Grady for uranium is just getting started, even though URNM moved 580% in its baby bull move up from 2020 low. Both SPUT and URA have moved equally big lately, therefore still at gray line. When the backtest is done, the major wave 3 should be next. Major wave 3 should be next for URA versus SPUT. So hopefully, and I hope this is right, this pattern here, I'm hoping that the equities can outperform the commodity itself. And I think we're just early in this big mix. Someone said, or asked the question, under what circumstances is it acceptable to quit? Well, when the game changes and you sign up for something that maybe you didn't sign up for. So if it's for a job or something like that, they describe a job that you're supposed to be working for, and then you start working a job that's entirely different that you don't like. That would be reason to quit. If you don't like what you're doing, and they describe the position completely opposite of what you are doing after you got hired, that I would consider to be acceptable. There's a whole bunch of other things. If they treat you like crap, they attack you personally or something like that, the culture that they have at a workplace, that would all be acceptable to quit. Maybe you're just not a good fit. If it's a new job and you just feel like you're struggling, maybe they're not training you at all. Those are all reasons that I think are acceptable to quit. Being on a losing team and the team exhibiting characteristics that it's just falling apart, and you don't want to be a part of that team falling apart is another one too. Siemens Energy getting massive multi-billion-dollar bailouts from the German government. Sorry, but wind power is not the future. That's reality. The Great Green Fraud showing its true colors once again. Are you starting to understand? Millionaire mentality. He says, I owe $40,000 on my 2.6% mortgage. I have $70,000 cash earning 5%. Mortgage will be paid off in 2.5 years if I just keep making the monthly payments. Do I let it ride or just pay off the balance? Well, what do you guys think? What's your opinion there? I would probably just slowly pay off the balance. I probably wouldn't just pay it off all in one shot. There's no reason. If you've got 5%, if you're earning 5% on 70K, why not just let it pay off and cash flow your mortgage? That's what I would do. According to Kipler, global oil inventories have erased the builds of the past 2 months and now stand at their lowest levels as far back as their data set goes in 2017. Weak demand, Iranian export surge, SPR release, disappointing China reopening, etc. Despite it all, here we are and heading lower still. That's your global observable oil inventory, guys. It's getting eaten up. What happens first is your inventories drop, and what happens second is the price goes up dramatically until we find a demand destruction price. Silver, energy is building, not the time to take your eyes off the ball. Check the quarterly candle forming so far. Are you watching this historical moment in time? The mother of all legit looking probable cup and handles in silver that is working. First, it had a picture-perfect quintuple support backtest to pink handle arc. Black line, gray line, blue line, plus fib 62%. That is stylish. Then it formed the huge bullish blue expanding falling wedge as backtest pattern. Are we going to get a big break here on the quarterly chart of silver as we move through? I don't know. We're going to have to wait and see, but this is a massive cup and handle pattern, and hopefully this thing breaks to the upside and takes it to the motherland, is what I'll say. This is interesting. Global floating storage, way down there, guys. Way down there for 2023. So global floating storage, definitely some of that inventory is coming off of global floating storage. Here is, and for those nat gas bulls, talking about LNG demand growth. Yes, it's coming, but it's not coming in 2024. Demand bump won't hit until late 2024. So if production is elevated and this winter isn't at least normal, 2024 injection season is bloated if we don't get a little bit of cooler winter. And this is what it looks like for LNG feed gas for the lower 48. You can see this is just left to right for LNG terminals that are opening capacity. So we could overproduce, it's possible, and we could get a little bit of weakness in the short term of 2024, depending on the weather this winter. 4.3% Treasury yield move in a matter of hours is highly atypical. Some would say extraordinary. Look at this move here, guys, on the right-hand side. Massive move higher for a Treasury yield move as they were selling bonds, and it was not a favorable auction. So yields definitely moved higher when they tried selling those bonds. We've got personal savings rate at historic lows, extremely low levels of historic rates. So beware, personal savings rate has collapsed with credit card debt above 1 trillion and personal interest payments crossing 500 billion. The consumers are heading for trouble, is what he is suggesting. But if you look at history, though, it's not like totally out of norm. I would say the savings rate in 2020 and 2021 was out of the norm. So if the saving rate comes back down, obviously they've saved all this money back here. So we could probably go even further to the downside without being, completely in abnormal areas. Solid read here. When the Fed cuts rates, it's not going to be bullish like many think. It will be because things are slowing down hard. Black Swan fund manager says start worrying when Fed cuts rates. Where you can see this is the 2-year yield. The Fed just does whatever the 2-year yield does. So if you see the 2-year yield drop dramatically, that's generally when you could see a slowdown in the market. Eric says, does this look like an unhealthy oil market when global inventories sit at their lowest levels since at least 2017? And this is after having absorbed 300 million barrels from the strategic political reserve. And there we are at some of the lowest levels over the past 5 years. So that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. We've got a question and answer session that's occurring right now, 7 a.m. On Saturday, this is when I release the videos. It's 7 a.m. Mountain Standard Time. So if you're not over there in the meeting and you're a platinum member, go hit it up. Go join me. Ask me whatever questions. Maybe just sit and watch what other people are asking. But that's what I've got for today. Hopefully everybody's having a good day. Have a good weekend. And we'll catch you later. This is Finding Value.